Welcome to the course on risk modeling in insurance. This video provides you with an introduction to claims reserving, also called loss reserving, for non-life insurance. Here is the list of topics that will be covered throughout the series of videos on claims reserving. You will first motivate the need for claims reserving. You will study the available data sources and the actual goal of a claims reserving model. Next videos will then cover a set of techniques to estimate or to forecast the reserve. That's the chain ladder method, max distribution free chain ladder model, the use of generalized linear models for claims reserving, and the technique of bootstrapping to get a predictive distribution of the outstanding reserve. The lecture sheets are based on the following set of books and lecture notes. For background reading and more details, I kindly refer you to these resources. So in this video, you will study the lifetime or the development of a typical non-life insurance claim. And you should picture this development as follows. An accident or an insured event occurs at time point T occurrence. It is reported to the insurance company at a time denoted as T-rep, where rep is for reporting. And that reporting takes place after some delay, the reporting delay. Now, if the claim filed is accepted by the insurance company, payments will follow. And in this example, 3 payments follow at time points T1, T2, and T3. Eventually, the claim settles or closes at a time point denoted here as T-set, where set refers to settlement. Now, the timeline pictured on the previous sheet learns you that usually the insurance company is unable to settle a claim immediately, and that's because for one of the following reasons. Delay in reporting exists typically. That is the time that elapses between the occurrence of the insured event or the accident and the reporting of this event to the insurance company. Claims do not get settled immediately, and you will label the time that elapses between reporting of a claim and its settlement as the settlement delay. For example, it is very intuitive that a material damage claim typically settles quicker than a bodily injury claim that involves a complex type of injury. Closed claims may also reopen due to new developments. For example, in case of a bodily injury, the injury may require extra treatment. Now, put together, you should be convinced that the development of a claim typically takes some time. And this delay will require the insurance company to hold capital in order to settle the claims in the future. Now, before moving further to the actual goal of calculating reserves, you will first become familiar with the different types of claims based on the status of their development that can be distinguished. A first type of claim is a closed claim. For these claims, the complete development has been observed. With the red line in the picture here indicating the present moment, you see that all events related to the claim's development take place or took place before the present moment. On the other hand, a so-called RBNS claim is a claim that has been reported but is not fully settled at the moment of evaluation. That is the moment when the reserves should be calculated and booked by the insurer. The present moment thus. Occurrence, reporting, and possibly some payments of an RBNS claim already took place before the present moment, but the closing of the claim will happen in the future. A third type of claim is an IBNR claim. That is a claim that incurred but is not yet reported. For such a claim, the insured event took place already, but the insurance company is not yet aware of the claim that comes with it. This claim will be reported in the future. Its complete development takes place in the future. Now, when motivating the task of calculating reserves, it is important to consider the so-called inverted production cycle of an insurance company. That is, in the insurance business, the premium income precedes the costs. That is, an insurer will charge a client a premium before actually knowing how expensive this insurance policy or contract will become. In typical manufacturing industry, this is not the case, and the manufacturer knows before selling a product what the cost of realizing this product was. However, in an insurance setting, the total cost can only be evaluated a posteriori, that is, after the closure of the contract and the complete payment of all claims that are related to it. But as we said, on the contrary, premiums are paid before the start of such a contract. Now, because of this inverted production cycle, at any point or at any evaluation moment, denoted here as tau, the insurer will predict his outstanding liabilities with respect to contracts sold in the past. This estimate is referred to as the claims reserve. It is the capital necessary to settle claims from past exposures. It is a very important element on the balance sheet of the insurance company, more specifically on the liability side of this balance sheet. Now, with your background on the need for claims reserving, you will now move forward with considering the kind of data that are available to estimate reserves from. Well, non-life insurance companies register data on the development of an individual claim as sketched in the timeline on the left-hand side in this graph. We will refer to data registered at this level as granular or micro-level data. So these are the data that are available for an individual claim and the events that happen during a claim's lifetime. It is the most detailed, fine-grained level at which data are available. Now, what actuaries typically do is they aggregate the information from these individual developments across all claims in a portfolio. This aggregation leads to data structured in a triangular format as shown on the right-hand side in the graph. Such data are called aggregate data or macro-level data, since each cell in the triangle contains aggregated information from the development of multiple claims. So it is clear that we went here from micro-level granular data to macro-level aggregate data. And this triangular structure that we introduced over here, this triangle used in claims reserving, is called a runoff or development triangle. It aggregates the records registered on individual claims. On the vertical axis, the triangle lists the accident or occurrence years during which a portfolio is followed. That is, payments registered for claims are connected with the year during which the accident occurred. On the horizontal axis, the payment delay since occurrence is followed. Zero delay means here or is used here for payments made in the year of occurrence of the accident or the insured event. 1 year of delay is used for payments made in the year after occurrence of the accident. For example, the cell here at position 2004, 0, displays the number 5,947. And that is the total amount paid in the year 2004 for all claims that occurred or that happened in the year 2004. That is, it is the total amount paid with 0 years of delay on all the claims that occurred in the year 2004. Similarly, the number in cell 2012-1 displays the total 2,357.9 that is paid in the year 2013 for all the claims that occurred in the year 2012, and so on, right? So that is the type of information that you can find in an incremental runoff triangle. Whereas the triangle on sheet number 11 displayed incremental payment data, the triangle shown over here shows the same information but in cumulative format. In this case, cell 2004-1, for example, displays the total claim amount paid up to and including development year 1 for all claims that occurred in the year 2004. Therefore, it is the sum of the amount paid in 2004 and the amount paid in 2005 for accidents that occurred in 2004. We call this the cumulative runoff triangle. Now, to formalize both displays, let us introduce some notation. In our notation, I will refer to the accident year. That is the year in which the insured event happened. The first accident year considered in the portfolio is denoted with 1, and the last accident year that we consider is denoted with capital I. J refers to the development year, or the development period, where development year 0 is the accident year itself. The random variable xij then denotes the incremental claims in development period j for accidents that happened in accident year I. Thus, xij is the total amount paid in development year j for all claims that happened in occurrence year I. And in fact, those payments take place in accounting year or calendar year I plus j. Taking a cumulative point of view, Cij is the cumulative amount paid up until and including development year j for accidents that occurred in year I. Ultimately, a total amount Ci capital J is paid in the final development year j for claims that occurred in accident year I. And the final development in our cumulative runoff triangle would be the last column in the triangle. In these lecture sheets, the time unit or the time period used is 1 year, but other units, of course, can be used as well, like semesters or quarters. Now, at a certain point in time, called the evaluation moment, the data in the upper triangle are observed, whereas the lower triangle in this display has to be predicted. Here, the evaluation moment is the end of the most recent accident year, so that's the end, in this case, of accident year capital I. And therefore, a cell ij for which I plus j is smaller than or equal to capital I is an observed cell, whereas a cell for which I plus j is strictly larger than capital I is a cell in the future and therefore has to be predicted. Now, different pieces of information can be stored in a runoff triangle, and depending on the data in the triangle, you will estimate different quantities. For example, in incremental format, the random variable xij may denote, for instance, claim payments, as motivated before, could also denote the number of claims that occurred in year I and are reported in year j. That is the type of data necessary to estimate the number of IBNR claims, incurred but not yet reported claims. It could also contain or refer to the change in incurred amounts, where incurred claim amounts are the sum of cumulative paid amounts plus case estimates. And the case estimate would be the claim handler's expert estimate of the outstanding amount on a claim. Now, in cumulative format, the Cij random variables may indicate cumulative paid amount paid up to and including development year j for claims that occurred in year I, the total number of claims reported until development year j with occurrence in year I, or the incurred claim amounts. Now, besides these data, other sources of information are potentially available to the actuary. For example, covariates may be available, like the type of claim, whether it's a bodily injury claim, a material damage claim, and so on. External information might be available, like inflation, change of jurisdiction, state of the economy or the financial market, and so on. Most claims reserving methods are designed for runoff triangles and are therefore based on a single source of information. Now, having this context and this notation in mind, you're now ready to formulate the purpose of a claims reserving exercise in some mathematical notation. When working with a runoff triangle with cumulative claim figures, the goal is to estimate or to predict the ultimate claim amount for occurrence year I. That is CI, capital I minus 1, where capital I minus 1 denotes the final development period. That is the last column in the runoff triangle. Recall that in the notation used in our sheets, the development periods are labeled from 0 until I, capital I minus 1. This is the random variable you will find on row I, last column in the triangle. That is the CI, capital I minus 1. And we assume that beyond this period, no further payments will follow, although this assumption can be relaxed. Since CI, I minus 1 is cumulative, it includes both an observed part and a part that has to be predicted. And therefore, the outstanding liability for accident year I can be written as follows. So you express the reserve either as a sum of incremental random variables, incremental data, where each term denoted here is denoted here with XIL. Or you express the reserve as a difference between two cumulative numbers. In the latter case, the outstanding amount, so the amount, the cash flow that will follow in the future, is the ultimate claim cumulative amount minus the most recently observed cumulative amount. We use the notation calligraphic R with subscript I to refer to the reserve with respect to occurrence year I. The superscript 0 that we use over here indicates that predictions are made at the present moment, so right now. And in our case, that is at the end of occurrence year, capital I. That's the most recent calendar year during which data are observed and registered. So that's important to keep in mind. This is your mathematical notation for the reserve expressed in terms of incremental random variables or expressed as a difference between two cumulative amounts. Now, as explained on the previous sheet, the superscript 0 refers to reserves calculated at the end of year capital I, that is the present moment. But reserves will also be calculated later on in time, using the most recent information available. So let t refer to such a future time point and let calligraphic ft be the information available at time t plus I, capital I. The best estimate reserves calculated at time t will then be denoted as calligraphic R with a superscript t. And these estimate the incremental claim amounts or the cash flows that will be paid beyond time t plus I and will capture the remaining future runoff of the claims related to past exposures. Now, the so-called best estimate reserve as calculated at time t, using information as observed until the end of year capital I plus t, typically correspond to a conditional expectation, where you work conditionally on the available information. So to express this best estimate, you're going to use this conditional estimation. And the head notation on the sheet here refers to the fact that model parameters have to be estimated in the models that we use to do this, to calculate this expectations from. So as a wrap-up, the essential information from sheet 17 and sheet number 18 is the following. So first of all, reserves will be calculated at the end of year capital I, but also 1 year later, 2 years later, and so on, taking into account the most recent information available regarding the development or the runoff of claims. Second, Best estimate reserves rely on conditional expectations of incremental or cumulative random variables where unknown model parameters have to be estimated. So keep that in mind for these two sheets. Now, having an estimate of the expected outstanding claim amount at your disposal, two typical next tasks are: first, adjust the nominal best estimate reserves for the time value of money using a discounting function. And here we refer to Article 77 of the European Solvency II Framework Directive that says, and I'm quoting, "The best estimate shall correspond to the probability-weighted average of future cash flows, taking into account the time value of money," right? So that is exactly what we refer to over here. Second, you will typically add a risk margin to the expected value that is calculated in the best estimate setting, and you will do this to protect against deviations from the expected value. So the sum of the best estimate and a risk margin, that's what we refer to as the technical provision. And hereby the risk margin shall ensure that the value of the technical provision is equivalent to the amount that insurance and reinsurance undertakings would be expected to require in order to take over and to meet the insurance and reinsurance obligations, as it is phrased in the Solvency II directive. Now, the risk margin that comes on top of the best estimate can be considered, can be regarded as a compensation for the risk of taking on an obligation to pay uncertain cash flows, as it is the case here with the future development of claims related to past exposure. So in addition to serving as an element of the price in a transaction from one party to another, a risk margin makes it possible to observe volatility in experience. If experience is more favorable than assumed, the release of the excess risk margin creates a profit that serves as a reward for the investor that has taken the risk. But if experience is worse than expected, the risk margin covers some part of the expected losses. So two things to keep in mind: the discounting of, or the calculation of discounted best estimate reserves, and the calculation of a so-called risk margin, which will then lead you, in combination with the best estimate, to the so-called technical provision. Now, the claims reserving methods and models that will be covered in this set of videos will focus on one or multiple of the following goals. So they will allow you to obtain a best estimate for the outstanding liabilities on past exposures. They let you quantify the corresponding uncertainty as a mean squared error of prediction that comes with this best estimate. Combining the best estimate and the standard error then allows you to derive a prediction interval for the outstanding claim amount if you're willing to choose a particular distribution to construct this interval. Or the methods that we will cover will allow you to simulate from the predictive distribution of the outstanding loss liabilities. And from this distribution, risk measures like a value at risk, for instance, could be estimated. That's interesting when you're calculating the risk margin. Traditionally, the literature on claims reserving took a long-term or ultimate perspective, with focus on estimating the cash flows over the complete runoff of the portfolio and measuring the corresponding uncertainty in these cash flow predictions. However, with the introduction of Solvency II, focus is no longer exclusively on this ultimate claim amount, but actuaries will also assess how reserve estimates change on the short term. The so-called reserve risk in Solvency II, for instance, measures the changes in reserves as estimated over a 1-year time horizon. And essentially you ask yourself here, how does this reserve estimate change when a new diagonal would become available in my triangle? So that is what reserve risk tries to capture. To conclude this video, let us mention that several commercial providers offers special purpose software for claims reserving, including tools to calculate best estimates, to calculate standard errors, and to set up simulations from the predictive distribution of the outstanding reserve. In this case, you will find out more about the functionalities. In this course, you will find out more about the functionalities that R offers to do similar tasks.